November 2025, $200 billion in AI market value. Gone. Not gradually, but completely evaporated before lunch. A single earnings call triggered the panic, confirming Wall Street's fear that the massive financial returns promised by AI are significantly behind schedule. The investment frenzy that absorbed hundreds of billions of dollars has officially entered its panic phase. When markets reach this stage, casualties are swift. Investors who bought into aggressive growth narratives are left holding shares of companies that spent vast sums of money on promises they cannot fulfill. The underlying technology of artificial intelligence is highly capable, but we are watching a severe financial correction unfold. As the dust settles, the math suggests that roughly 90% of current AI-focused stocks are essentially walking zombies. To understand why the market is correcting violently, look at the spending. In 2024, major tech firms committed over $220 billion to AI infrastructure. They bought land, built data centers, and acquired specialized processors. That is a coordinated capital layout larger than the entire GDP of Portugal. Financial analysts at firms like Goldman Sachs have pointed out a stark reality known as the efficiency gap. The premise is simple. If you spend $1 trillion building out physical AI infrastructure, those systems eventually have to generate $1 trillion in real, measurable economic value to justify the cost. At the corporate level, spending $100 million upfront for an AI system that saves $10 million annually means a 10-year payback period. Because a dollar today is worth more than a dollar over a decade, the net present value is mathematically negative. For 3 years, public markets rewarded tech companies simply for announcing AI investments. That premium for future vision has expired. Analysts on earnings calls have stopped asking about long-term AI strategies and are demanding to see current AI revenue. The models work, but deploying them at a global scale while remaining profitable is proving to be a much steeper engineering and financial challenge than the initial Silicon Valley pitches suggested. This brings us to the most dangerous hazard in the 2026 stock market, the AI zombie. These companies maintain active public relations, they hire new staff, and trade on public exchanges, but have absolutely no viable path to generating the profits required to support their stock prices. We saw exactly this behavior during the dot-com bubble of 1999. Back then, retail companies with no sustainable competitive advantage watched their valuations double simply by appending .com to their corporate name. The modern equivalent is AI washing. Over the last few years, a business could boost its stock price by 20% just by injecting the phrase "powered by generative AI" into a press release, or by announcing the hire of a chief AI officer. But relying on a trendy vocabulary is a temporary strategy. As investors look past the branding and scrutinize the actual cash flows, the highly speculative valuations attached to these companies are dropping rapidly. Visualizing the revenue versus earn ratio, spending $5 on compute for every revenue dollar means borrowed time. Shifting to gross margins, AI's high computational cost traps margins below 40%, making it mathematically impossible to cover debt. The catalyst accelerating this collapse is the Federal Reserve. By maintaining a higher interest rate environment, the Fed effectively ended the decade-long era of zero-cost capital that gave birth to this startup ecosystem. Consider the calculus for a mid-sized AI startup. If they operate at a $50 million annual loss and they need to raise $500 million to survive the next decade at a 5% interest rate, they now owe an additional $25 million every single year just to service the debt. Venture capital firms see this math, and they have quietly stopped funding these early-stage ventures. This brutal great filter is actively stripping away the companies that were designed exclusively for a cheap money environment. Smart capital is moving away from the mature GPU trade and into the unglamorous infrastructure companies solving the hard physical constraints of artificial intelligence. The strictest limit on AI is electricity. A single large-scale AI data center can demand up to 500 megawatts of power. Across the United States, the localized demand from planned server farms is now physically exceeding the current capacity of regional utility grids. Tech giants are realizing that continuous, carbon-free energy at this scale leaves them with exactly one option: nuclear power. In 2024, Microsoft literally signed a deal to reopen the retired 3 Mile Island nuclear facility, specifically to run its AI data centers. Then there is the thermal problem. Advanced AI chips generate so much heat that traditional air conditioning fails. The industry is currently paying billions of dollars to specialized engineering firms to install next-generation, direct-to-chip chilled water systems under their data center floors. The real wealth being generated in this sector today belongs to the utilities, the grid infrastructure providers, and the thermal management companies quietly building the foundation for the AI era. Beyond the hardware build-out, established legacy corporations are emerging as the ultimate winners, using artificial intelligence as a competitive weapon to streamline their existing operations. Look at Walmart. They aren't pitching themselves as an AI company. Instead, they use machine learning models to map hyper-efficient delivery routes and predict individual store inventory. Those highly specific applications translate into hundreds of millions of dollars in operational savings right now. JP Chase has adopted a similar strategy. By using predictive models to instantly flag fraudulent transactions and automate tens of thousands of hours of legal document review, the bank is generating billions in immediate, measurable returns. Unlike AI zombies, these legacy firms possess massive, entrenched revenue streams. For these giants, the technology acts as a lever to improve the profitability of operations that are already successful. The most successful investors in this decade won't be the ones chasing futuristic promises from unprofitable startups. They will be the ones who ignore the noise, look at the balance sheets, and follow the undeniable math of physical A $200 billion wipeout in a single morning. That staggering loss erased purely fictional value. The underlying technology works, but the software narrative collapsed upon contact with reality. This chart shows the core economic problem, the productivity paradox. The top line traces worker productivity sharply rising thanks to AI tools. But look at the bottom line. Corporate profit margins are plummeting at the exact same time. In a competitive market, when everyone gets more efficient, companies use those gains to undercut each other. The financial value of the productivity bypasses the corporation entirely and flows directly to the consumer through lower prices. Investors pouring capital into the AI application layer are paying a premium to fund their own margin destruction. They are buying into a mathematical trap. The real-world disruption is immediate. Call center operators, data entry clerks, and routine legal workers are seeing their roles displaced by automated systems right now. The sheer speed and capability of this rollout challenges the long-held economic assumption that new technology naturally creates more jobs than it destroys. Look at where the wealth actually accumulates. Massive financial returns are not distributing evenly across the economy. They are hyper-concentrating into a handful of mega-cap infrastructure monopolies. If the software layer destroys its own margins and disrupts the labor force, the logical move is to abandon consumer applications. Smart institutional capital is already flowing downward into the physical world. The economic winners of 2026 are not tech startups. They are industrial engineering and commercial real estate giants. Capital is abandoning cloud for concrete. The demand for data center capacity has massively outpaced physical supply. In Northern Virginia, the largest market in the world, companies are sitting on wait lists that stretch years into the future, desperate for rack space. Keeping those servers running requires a multi-trillion-dollar capital investment cycle. The decades-old U.S. electrical grid is physically incapable of handling the power load that AI workloads demand. Then there is the water. A single large language model training run can consume hundreds of thousands of gallons. This creates a massive, silent boom for the engineering companies developing high-efficiency industrial cooling systems. To deliver AI queries back and forth without latency, the data needs physical pathways. We are witnessing an expansion of fiber optic networks at a rate unseen since the late 1990s. The companies pouring concrete, managing the water, and laying cable are completely insulated from the software hype cycle. Whether a specific AI chatbot succeeds or fails, the physical infrastructure wins. This physical demand is guaranteed by something stronger than the free market. The global AI race operates as a national security competition, driven by entirely different financial logic. United States export controls severely restrict the flow of advanced chips to China. Consequently, domestic semiconductor fabrication has been elevated from an economic policy to heavily subsidized national security infrastructure. We are also seeing the rise of sovereign AI. Wealthy nations, particularly in the Gulf states, are pouring billions of dollars of oil revenue into domestic data centers to ensure they own their technological capabilities. Domestically, the defense sector procures AI for autonomous surveillance and complex logistics. When the military buys these systems, they are optimizing for safety and strategic advantage, making them largely immune to commercial price sensitivities. Governments and militaries provide an unlimited, multi-decade financial backstop for the hardware layer. It is the safest harbor available for investor capital. So, how do you position a portfolio to survive this? Step 1 is the profitability filter. Reject any AI investment that is not generating positive cash flow today. This bar chart outlines the secondary hurdle. In the current interest rate environment, any company falling below this 24-month cash runway threshold is a dangerous asset. High-burn companies get filtered out. Step 2 is the infrastructure allocation. 40 to 50% of the portfolio belongs in the physical build-out: data center real estate, grid modernization, cooling technology, and semiconductor manufacturing equipment. Step 3 is the silent winners allocation. Position 30 to 40% of your capital in traditional legacy businesses that are using AI internally to measurably reduce costs and expand their profit margins right now. This specific allocation framework pulls your wealth out of the speculative narrative. It ties your capital strictly to verifiable, present-day financial results. That $200 billion that vanished in morning trading was never actual value. It was vision priced as delivery, a fictional future evaporating upon contact with reality. The companies that held their ground that morning generate real power, lay actual cables, and pull in tangible cash flow. Their results do not disappear when a narrative cracks. The great AI reckoning of 2026 marks a healthy transition. The market is finally learning to value physical delivery over software promises. You have a choice. You can leave your wealth exposed to the decaying end of a hype cycle, or you can align it with the multi-trillion-dollar physical build-out happening underneath it. In every technological revolution in human history, the narrative eventually fades and the building begins.